In this presentation, we're going to add inventory purchase with the use of bank feeds. In other words, we're going to see cash going out for the purchase of inventory and think about how we're going to record that on the financial statements. Inventory being one of those confusing components when we're thinking about being on a cash basis process, because it's one of those things that we'll typically need to pull away from a cash basis in order to deal with. We will discuss a few different options with regards to inventory. Time to engage with Sage Business Cloud Accounting. Here we are in our Get Great Guitars company summary page within Sage. We're going to be opening up our financial statements by going to the reporting dropdown, opening up the balance sheet first. We're going to do our similar process here as we did last time. We're going to be duplicating these tabs. So we're going to go back up top. We're going to be hovering over that tab, right click on it, duplicate it. So now we got the balance sheet to the right. We're going to go back to the tab to the left, do the same thing for the P&L, profit and loss, income statement. We're going to select that P&L from the reporting dropdown. Once opened, we're going to hover over that tab up top. We're going to mouse over it and then right click on it, and we will duplicate that tab as well. Then I'm going to go back to the balance sheet. We're going to adjust the dates, make sure the dates are where we want it. Looks like it memorized it last time. That's nice. It memorized it for us. So that's what we have so far. Let's take a look at the P&L and see if it did the same thing. I apparently didn't open the profit and loss properly. So I'm going to open up the profit and loss by going to the reporting and then the P&L. And it did memorize it as well. So it looks like that is on the correct dates. I like that. We're going to go back to the first tab then. And I'm going to go back to the banking. We're going to go within the banking in the ribbon up top. And we're looking at those bank feeds. We have 10 of them left. Let's check out those 10 we got to play with. Got to add, going to add to the financial statement. So here are our 10 items that are still in Sage bank feed limbo, and we're going to be pulling them over to the financial statement. So let's help them out. We're going to go down here. We're looking for the inventory items. So we're looking for items that are inventory related. Before we get into that, just going to point out inventory is one of those areas where we typically have to deviate from a cash basis system. Why? Let's take a look at a flowchart. I'm jumping over to QuickBooks Desktop just to look at the flowchart. They just have a nice flowchart on the desktop. So we're going to be over here just looking at the flowchart. As we've mentioned before, some types of industries lend themselves well to a cash basis, such as an e-services type of business. If you're making money from AdSense revenue, or you're making money from an Amazon affiliate marketing, then you could just record the income when you get it typically, and any expenses you had to incur in order to get that income, you can expense them as they go. Inventory is a problem, however, because typically inventory makes us deviate from a cash basis system. Why? Because there's a timing difference between when we get the inventory and when it helps us to generate revenue. And therefore, instead of us just expensing it at the point in time that we buy it, we typically have to put it on the books as an asset and then expense it in the time period in which it's been consumed or used to help us generate revenue in the same time period. That's an accrual kind of thing, because when we bought the inventory, we couldn't just expense it. We had to put it on the books as an asset and then expense it when we used the inventory, we sold it in order to help us to generate the revenue. So how do we deal with that if we're if we want to depend on the bank feeds as much as possible? If we're basically on a cash basis system and then inventory kind of messes us up, how can we deal with that? Well, there's a couple ways you can deal with it. One, you could do the full service inventory process, like a perpetual system actually does work within Sage. They will track the inventory for you, and that means that when you buy the inventory, you would put it on the books as an asset. So we'd have to go back and put the inventory on the books when we purchase it. That would record both the asset in terms of the financial statement, and it would track the inventory. In our case, we're selling guitars, so it would count the guitars and do track a number of guitars and tie that out to what's on the financial statements. And then whenever we sold, that would mean it would go up as an asset on the financials. And then when we sold the guitar, we would have to, because that's our inventory in our example, we would have to make an invoice or like a sales receipt. And then the system would, in a perpetual system, reduce the inventory both in terms of the financial statement as well as the supporting schedules tracking the inventory within the books to match that out. And so we would have to then both put it on the books as inventory, and we'd have to then use an invoice or a sales receipt rather than just recording the deposit when we get the goods or sell the goods. So that's a bit more complex of a system. That would be more of a full accrual system. The software of Sage does have the ability to do that. It's just a matter of whether or not you want to track the inventory within Sage. Another method, like a step down for that method in terms of complexity, would be to use a perpetual or a periodic type of system. Under that system, you might say, okay, when we buy the inventory, I'm going to put it on the books as an asset in the system, but I'm not going to use the system to count my guitars, to tell me different types of guitars that are on there and whatnot. What I'm going to do instead is I'm going to put that on a separate spreadsheet, and I'm just going to track my guitars, and then I'm going to count them periodically, like at the end of the day, the end of the month. And therefore, when I purchase guitars, I'm just going to increase my inventory on the books, and I'm going to have a supporting schedule of my physical count of guitars or whatnot, tracking the actual physical count somewhere else on a spreadsheet. And then when I make the sales of the guitars, I'm not going to record the cost of goods sold and the inventory at the point of sale. That would be a perpetual system. Instead, I'm just going to record it as if kind of the same thing if it was a service item, increasing the sales increasing sales and increasing cash or accounts receivable, not dealing with inventory. And then periodically at the end of the month or the end of the day or the end of the week, I will count my inventory and adjust the inventory down to the physical count that I counted it to, and record the decrease in inventory periodically, and the other side going to cost of goods sold. That would be the second method that's closer to a cash basis method. It's a little bit, you don't have to do the perpetual thing, you can do periodic type of inventory. Or the most cash basis way to do it would be to just say, hey, look, when I get a guitar, I don't hold on to it that long, right? Let's say someone comes into I don't have a lot of inventory possibly. Let's say my business is for someone to come buy a guitar, and I just go order it for them, and then I sell it to them right after I get the guitar. So I don't have a lot of inventory on hand. Well, then maybe you could get away with just a cash basis system in which you would just basically expense the guitar as cost of goods sold when you buy it, as opposed to putting it on inventory at all. And then you've already expensed it. And then when you create the invoice later, it'll match up to it. So then that would be the cash basis method. So what we're going to do here to be more dependent on the bank feeds is for the first month, use that method. We're just going to expense the inventory as we get it, with the assumption that we don't have a lot of inventory on hand, and so we're just going to expense it when we get it, and then everything will work out from a timing perspective after we make the sale on it. And then on the second month, we'll do the periodic system. So we're not going to track inventory in Sage, even though you can. So you can look into that if it's an option, do a perpetual system. On the second method, though, we're going to use a periodic system during the second month of operations. So inventory is one of those things that you want to check with your accountant and ask them what do you think is going to work best for taxes and for this, what do I have to do? But these are just some things to kind of think about. So I'm going to go through here. Also note that when you look at your bank feeds, you're going to have an idea of who your vendors are, who you buy inventory from, obviously. If you're doing if you're a bookkeeper, then and you're doing someone else's books, you're going to have to get an idea of who is their inventory items. They may look a little strange at first, but you'll see them over and over again after the first month of operations. So I'm going to go through this. Epiphone is one of our vendors that we buy inventory from. So I'm going to say that's one that we buy guitars from. They sell guitars. And I'm going to say the drop down. I'm going to create a new vendor. That's going to be Epiphone. And I'm going to call it an electronic transfer or electronic payment. And the account then, I'm going to see if we have cost of goods sold. That looks like they have the cost of sales. So I'm going to put it into the cost of sales account. So that's going to be it. What's this going to do when we record it? It's going to be decreasing the checking account, which has a negative balance in it, but that's okay. And the other side is going to be going to the cost of goods sold or cost of sales. Let's go ahead and create that. And then if we just take a look at that one before we go too far, if I go to the accounting tab or the balance sheet tab up top, and I calculate this, then we should see a change to the checking account. If we go on into that checking account, let's check out the checking. There it is. There's the change there. I'm going to go back then to the balance sheet. Let's take a look at the income statement, or the P&L, the profit and loss. Let's do a recalculation of it and see what happens there. We should see something going on with the cost of sales item. There's the cost of sales item. Looks good. Things are happening as was expected. Now, the next one is Gobson, which is spelled wrong. It should be Gibson, guitar distributor, but we're going to say that's how they spell it because that's what came through the bank feeds, and whatever came through the bank feeds is right. So I'm going to say that we'll create this one for Gobson, the guitar distributor, who we're purchasing from, and this one too will be the cost of sales. That's the one we want. Going to add this, going to have a similar effect on the financials. Then we have the Epiphone. Notice it's memorizing Epiphone now, so that's going to be helping us out. So it kind of memorizes the transactions. This isn't perfect. This isn't a bank rule that we're setting up here, but it's kind of memorizing the transactions. And note, again, if you have those types of transactions where it's going to have the same vendor and the same account each time, then it'll do a good job memorizing the transactions. However, if you have those type of transactions where you have the same vendor that goes to different accounts sometimes or another, then this will not always be perfect. So just be aware of that. If you're having someone else kind of help you out with the books, you want to kind of note those areas where the suggestions are not exactly correct. So just be aware of that, but that of course can be very useful. It is correct in this case, so we're going to go ahead and create that one. Then we have the draw and we have the bank charges. So I think that's it for us. Let's just double check. Yep, I think that's it. Let's go back then to the balance sheet and recalculate. We're going to recalculate this one. That makes an adjustment to the checking. I won't go into it because it's we've seen the checking account a few times. It's going to be decreasing by those payments. Let's go over to the P&L and let's recalculate that. And we'll see these adjustments to the cost of sales line item. If I then go into the cost of sales and check out the changes to it, we'll see these line items here. There they are. We got Gibson or Gobson, Epiphone, and Epiphone. So note what we did here. We expensed as cost of goods sold, in essence, the inventory. So we didn't put it on the books as inventory. This is basically inventory, but instead of us doing the two-step method, which you would typically do, put it on the books as inventory and then expense it at the point of sales, either using a periodic system or a perpetual system, we just put it directly on a cash basis to the income statement. So if you were to make a sale, if you're not holding on to a lot of inventory and you were to make the sale, you just turn around and sell the inventory very quickly, then this may be a method that's, that can work. Not really a problem. You might have to talk to your accountant about it and see if they can do it on an end of the year adjustments for any inventory that is currently on hand or something like that. So that's the first. This is basically a cash basis method of with the use of inventory, having inventory and staying on a cash basis method. Now, again, remember that taxes and whatnot, this inventory is one of those areas where they often can require you to deviate from that method. So just you got to talk to your accountant as to what would be best. But in any case, this would be a cash basis kind of inventory method. Next time we'll look at a periodic type of inventory method where we're not going to be tracking the inventory through Sage, even though Sage has the capability to do that, the full perpetual system. But a periodic system might be useful to some industries as well, because again, it's kind of a more simplified type of method in that you'll be reliant on a physical count and to do the periodic count and make an adjustment. It's one step up in difficulty because you still have to record the inventory on the books as an asset and then make an adjustment. We have to then make that adjustment to take it off the books as an asset and record it as an expense. But we're not doing it perpetually every time we make a sale. Instead, we're just doing it periodically. And so we'll do that in the second month. But that's going to be it for now. Let's get out of here.